Welcome back to FinEnergy, your go-to channel for actionable financial advice. Today, we're going to talk about something that plays a major role in your financial life, your credit score. Whether you're planning to buy a home, take out a car loan, or even get a credit card, your credit score is one of the most important factors that lenders look at. But what exactly is a credit score, and how can you improve it? If you've ever wondered why your score seems so mysterious or how it's calculated, this video is for you. We'll break down the truth about credit scores, why they matter, and how to improve your credit score, even if it's not where you want it to be right now. By the end of this video, you'll have a clear understanding of how to boost your credit score and, in turn, unlock better financial opportunities, like lower interest rates and better loan terms. So, let's get started. What is a credit score? Understanding the basics of credit scores and how they affect your life. Your credit score is a three-digit number that lenders use to evaluate your creditworthiness. In simpler terms, it's a way for them to determine how risky it is to lend you money. Credit scores range from 300 to 850, with higher scores indicating better creditworthiness. The most common credit score models are from FICO and VantageScore, and while they use slightly different formulas, both are widely used by lenders to make decisions. Here's how your score breaks down. Payment history, 35%. This is the most important factor. It includes your track record of making payments on time. Late payments, collections, bankruptcies, and foreclosures can negatively impact your score. Credit utilization, 30%. This refers to the amount of credit you're using compared to your total available credit. If you have a $10,000 credit limit and you're using $8,000, your utilization is 80%. This can hurt your credit score. Keeping your credit utilization below 30% is ideal. Length of credit history, 15%. The longer you've had credit, the better it is for your score. Lenders like to see a long, positive history with credit because it shows you can manage debt responsibly. Credit mix, 10%. A diverse range of credit accounts, credit cards, mortgages, car loans, etc., can be beneficial for your score. Having a mix of different types of credit shows that you can manage various financial products. New credit, 10%. Each time you apply for new credit, a hard inquiry is made, which can slightly lower your score. Applying for multiple credit cards or loans in a short period of time can signal to lenders that you might be in financial trouble. Key takeaway: your credit score is a reflection of how you've managed debt in the past. It's based on several factors, but the biggest one is making sure you pay your bills on time and avoid overusing your credit. 2. Why does your credit score matter? How your credit score affects your financial life and opportunities. You might be wondering, why does my credit score even matter? The reality is, your credit score can impact almost every aspect of your financial life. From buying a home to getting a car loan, your score is one of the first things lenders check to decide if you're a good candidate for credit. Here are some ways your credit score can affect you. Better loan terms. Higher credit scores typically mean lower interest rates and better loan terms. If your score is high, you're more likely to qualify for loans with favorable terms. A lower score can lead to higher interest rates, which can cost you more in the long run. Buying a home. When you apply for a mortgage, your credit score is one of the first things lenders look at. A higher score gives you a better chance of getting approved and securing a lower interest rate. For example, a 700-plus credit score might get you a lower rate than someone with a 650 score. Car loans. Similar to home loans, car loans depend heavily on your credit score. A higher score means you'll get a better rate, while a lower score can result in higher monthly payments or being denied credit altogether. Credit card approvals. Credit card companies also use your credit score to decide if you'll be approved and what interest rates you'll get. A higher score gives you more access to credit, while a low score could leave you with high interest rates or even a denial. Renting an apartment. Some landlords check credit scores when deciding whether to rent to you. A poor credit score might raise a red flag, even if you have the money to pay rent. Key takeaway: your credit score is a powerful tool. A good score opens doors to better financial opportunities, while a low score can make it harder to achieve your goals. It's worth taking the time to improve and maintain a healthy credit score. 3. How to build and improve your credit score. Actionable tips to improve your credit score and unlock better financial opportunities. Now that you understand the importance of your credit score, let's talk about how to build and improve it. Whether you're starting from scratch or trying to boost a low score, the steps are straightforward, but they require patience and consistency. Pay your bills on time. Your payment history makes up 35% of your credit score, so paying your bills on time is the most effective way to improve your score. Set reminders or automate your payments to ensure you never miss a due date. Reduce your credit utilization. Aim to keep your credit utilization under 30%. If you have a credit limit of $5,000, try not to carry a balance higher than $1,500. If possible, pay off your balances in full each month to avoid accumulating interest. Build a positive credit history. If you don't have much of a credit history, consider opening a secured credit card or becoming an authorized user on a family member's credit card. This can help you establish a track record of positive credit use. Avoid opening too many new accounts. While it's important to have a mix of credit types, opening too many new credit accounts within a short time can hurt your score. Each inquiry drops your score slightly, and having too many new accounts can signal financial instability. Dispute errors on your credit report. Mistakes happen, and sometimes your credit report might contain errors that are hurting your score. You're entitled to a free credit report once a year from each of the 3 major credit bureaus. If you spot any mistakes, dispute them directly with the credit bureau to have them corrected. Consider credit builder loans. If you have no credit or need to rebuild your score, a credit builder loan can help. These loans work by depositing the borrowed money into a savings account, which you pay back in installments. Your payments are reported to the credit bureaus, helping you build a positive credit history. Keep old accounts open. The longer your credit history, the better. Even if you no longer use a credit card, keep the account open. This helps increase the length of your credit history, which positively impacts your score. Key takeaway: improving your credit score is a gradual process, but by paying bills on time, reducing credit card balances, and building a positive credit history, you can make significant progress. Your credit score is crucial to your financial success, and improving it is possible. By paying on time, reducing credit usage, and building positive history, you can unlock better opportunities. Thanks for watching. Like, subscribe to FinenserG, and share this with others. You've got this.